Hello everyone, Dividend Enjoyer here, and today I'm going to be doing a stock analysis video of Apple stock, ticker symbol AAPL. Apple's been hit very hard recently, obviously with the tariff news and just weaker growth than what a lot of people are expecting, especially given the insane valuation that it has on it. I used to hold Apple in my personal portfolio, but I made the decision to actually sell out of Apple at around, I believe, 250, 240, around there. Simply because I did a stock analysis video on Apple stock, and I thought that the valuation was too high because there hasn't been enough consistent growth, and it didn't seem to me like Apple was really working very hard to generate more growth. I think that Apple is the type of company that's very similar to Coca-Cola, where it's an excellent company that people love, and a lot of people use their products, but the valuation might not necessarily justify the amount of growth that they can have. To put it in kind of more simple perspective, I think that Apple has pretty much gone everywhere that they could possibly go. I think that they've done everything they could possibly do to get their iPhones in different places. And I don't really see a lot of growth from Apple overall as a company when you compare it to something like Microsoft or Amazon or even Meta. It just seems like they're kind of resting on their laurels, which is completely fine because they're generating a lot of money. But I don't think that as an investor, you would want to necessarily get in. Now, I'm also not saying that if you've made a lot of money off of Apple, it's a good time to sell out. It just depends on your own current investing philosophy and kind of what you want. If you want a company that's going to very consistently deliver good results to you, I think that Apple is great. I think it's going to continue to generate great results. I think it's maybe the most sound, safest company you could be involved in. The amount of people that switch from the Mac ecosystem once they're in is only like 8% or maybe even 4%. It's very low for the amount of people that once they get an iPhone, they go back to Android or a Google or another competitor. So I think that Apple is very safe and very secure in their amount of sales, but there are definitely some concerns over so much of their supply chain being in China. And this is a very expensive stock in terms of the amount of growth you're getting for the price. Now, looking at the stock performance, Apple is up 12.23% over the past year, which is kind of misleading because the stock currently trades for $198.15 a share. And we can see that the 52-week high was $260.09, and the 52-week low was $164.08. It has a market cap of almost $3 trillion, 2.98, and a price to earnings ratio of 31.5. Apple also does pay a 0.5% annual dividend. I think that the stock is in a better place than it was before if you were looking to invest in it. Obviously, every stock has been hit very hard by tariffs, but this is especially concerning when you think about how much of Apple's labor is centered in China. And if we go to the analyst opinions on Apple, we have 46 analysts rating the stock total, with 7 rating it a strong buy, 21 rating it a buy, 15 rating it a hold, and the rest rating it a sell. And the analyst price targets range anywhere between 165 to 300, with an average analyst price target of 238.75. So obviously analysts are kind of all over the place on this stock, and it kind of makes sense too because everything's sort of up in the air in terms of tariffs, because the tariffs are really going to cause higher costs, and Apple really has kind of just two options here. They can either eat the costs and charge the same amount for the iPhones and make less money, or they can charge more money for the iPhones and pass that cost on to the consumers and risk losing people that they've already gotten that love the products and are all in on the Apple ecosystem. So Apple has a very difficult decision to make if these tariffs stay at the extreme rate that they are with China. And there's a lot of uncertainty there. I don't necessarily like uncertainty when I'm owning a stock. I do think that if Apple is cheap on a DCF basis, then it's probably a buy because I think that it's very safe. You know, it's a very difficult company to justify buying into if you're paying a premium on it right now because it seems like all of the surprises could be negative. I will say that the App Store has been great for Apple. Every couple of years, they bring out a great product like the AirPods, like the MacBook, and all of these products kind of sync together very well. I think that the products are very user-friendly. I think that people who buy Apple are very much not as much supercomputer people, but more they just want a product that works very well and is easy to use and increases their productivity. And I think that Apple does that better than anyone else. So I will say that it's an amazing company. But if you're buying it at a premium right now, I don't think it's the time. But let's go to the DCF model for an analysis on what the fair valuation might be. Here we have the weighted average cost of capital at 7.45%. And from what I could tell from the balance sheet on Apple, they did not have an interest expense for their debt. I'm not really sure exactly why, but this does just kind of make sense that maybe they're using this debt just as a tax shield or something like that. And it doesn't really affect the weighted average cost of capital very much. As you can see, they're only 3.46% debt weighted. So this weighted average cost of capital is very in line with this cost of equity when we have a beta of 1.26, an average market return of 7%, and a risk-free rate of 4.255%. Now, moving on to the actual DCF model valuation, we could see here that the average revenue growth has only been 2.06% a year on average, including the trailing 12-month number, which may be smaller because it's going to include some of these numbers from the 2024 fiscal year. So you could kind of disregard that, but it is higher, so it's helping them. You also have kind of outlier years, like from 2021 to 2022, the revenue increased by 7.79%, but we did see a decrease in the revenue from 2022 to 2023 of 2.8%. We also see kind of decreasing cash flows. I think that's because they're either buying stock back or paying off debt. But overall, that's not good when you have decreasing cash flows. But don't mistake it. Apple is very, very, very well financed, very intelligent about how they're using their money to generate shareholder equity. A very mature company as well. Like I said, not a lot of avenues where they're putting a lot of money at risk for growth. And one thing that I do just want to say as kind of a side note, I'm kind of surprised that they're not trying to be one of the leaders in AI, because when I really think about Apple, I think of a company that innovates and is first and wants to be involved in these big, massive tech fights. And you saw that in the early days with the Macintosh. You saw that with the iPhone. They're usually the leaders in innovation in some way. And I haven't really seen anything recently in the last 3 years that leads me to think that. But getting back on track, I put a growth rate of 7% on average for the free cash flow over the next 9 years, with a perpetual growth rate of 2.5% and that discount rate of 7.45% that we calculated earlier. Even with a 7% growth rate of the free cash flow, we can see that there's 11% downside to buying the stock. Now, I do think that you could justify a premium for a company like Apple that's able to generate more money than a lot of countries. However, they haven't really had the kind of growth that justifies this level of a premium. I mean, I don't think it's realistic for them to get this 7% growth rate, especially with the tariffs. I think it's more realistic that they're going to be around 5% on average a year, meaning that the DCF would be around 151. But again, if you can justify a premium on this because it is such a solid company, I think that you could definitely buy into Apple at around 160, 165 and be okay with that and hold it forever, because I do think that they are eventually going to find ways to grow. I do think it's a very difficult time for the stock, but my personal opinion is that the stock has not really been hit hard enough in terms of the valuation. Because when you have a valuation that's this high, the expectations also need to be high. And I think that a lot of Wall Street and a lot of just people in general are thinking, oh, it's Apple, they're going to make money. But if you do that in perpetuity, it doesn't really work. And I think that that's why it was a better time to buy Apple a couple of years ago than it is now, just because you're not going to get the same insane levels of growth. I think there's really good margin here, but you're not really actually growing the revenue on average. I mean, it's 2%, which is still fine. I mean, I think that what they're doing is correct. They're just collecting the money over time and continuing to collect money over time, and they're not really risking anything. But when I see Apple compared to something like Amazon that's investing in all these different things and taking on a lot of risk to try and grow the company, but they also have the big cash cow, I think that's more of what Apple needs to be doing for me personally. However, if you're someone who's already bought in at a cheap price, I would maybe just ride this out and collect your dividends. I don't think that you should necessarily sell out of a company that you bought at a very low valuation just because you could find something that is going to grow more. I think that if you have a significant holding in Apple and it's paying you a dividend that you're fine with, I think that it's still a very safe stock to be invested in personally. Of course, this is my non-financial advice, non-financial advisor opinion, but I think that it's a certain type of investor that wants a little bit more stability to get into Apple. But I wouldn't get in here. I would wait until the tariff stuff goes over and know exactly what's going to end up happening and then try to make sense of it. But if you're someone who's already been holding Apple and you're up significantly, you could either trim a little bit of it off and take some of your gains, or you could just hold the stock if you're happy with the dividend and you're happy to just hold it. I do think that you're going to have decent performance in the future, especially if you got in at the right price. But my opinion... Hello guys, Dividend Enjoyer here, and today I'm going to be talking about why I decided to buy more defensive stocks recently, and why I think it might be a good idea to be buying specifically Waste Management and some of the other REITs that I've had my eye on for a little while, but have been kind of hesitant to get into for a couple of other reasons. So before I get started, I'm just going to ask you guys humbly, can you please hit the subscribe button, because it really helps out the channel and it really helps me out. Now that that's out of the way, I'm just going to say I was talking about buying a lot of tech earlier in the year when everyone was kind of disgusted, I would say, with tech, with the kind of M&A spending that they had and just other types of spending that they've had in terms of developing a lot of the AI and a lot of the physical infrastructure, some of the hiring for AI. I think Wall Street's starting to sour on it a little bit. So it's kind of split, right? But really, tech was very undervalued for a while earlier, and you could see it. There was a big crash. There was uncertainty about these tariffs. There's a lot of uncertainty about the Fed as well. Just a lot of things that the market really did not like, and everything was crashing. And in that time, I said, this is when you want to buy tech. Like, you don't want to buy Waste Management right here unless you're really going to hold it for a while. Because Waste Management was rising, actually, at that time. It was actually the best performing stock in my own portfolio at the time when I was saying don't buy it. And the reason for that at the time was people were really scared, so they were putting their money in Waste Management. Well, now people aren't as scared, right? So Waste Management does not command the same sort of premium that it had previously, because people are trying to not miss the, get rich quick AI double triple Zuckerberg special that they're going to get tomorrow night outside of the Chili's. But instead, they really should be focusing on long-term gains that they could be getting in very safe defensive stocks with very, almost, not the G word, but pretty much guaranteed cash flows. You can't say guaranteed, obviously, but I think it's very unlikely that many of us are going to stop paying our garbage bills, which is why I really wanted to get into Waste Management and why I really thought that Waste Management could be a wonderful stock for the rest of my life. It has over a 1% annual dividend yield, but that's not the impressive thing. It's actually the fact that the compound annual growth rate of the dividend is very high. And if you pay attention to the industry, its economies of scale does matter, meaning that a bigger competitor could definitely bully a smaller guy, but M&A is not frowned upon in this area of the market, M&A is actually encouraged, and it usually makes sense because there's better synergies for the bigger garbage company because it's more difficult for them to grow. So there's a premium on the growth they can get. And for the smaller company, the larger company is actually offering them a value that's higher than the intrinsic value that they've calculated themselves for their own firm. So they're getting a premium on what they believe their own firm is usually. So everyone really wins in M&A in terms of the garbage industry, especially the banks that obviously write everything and collect that money. But they get more kind of equipment, shares, landfills, all that sort of thing, and they continually do that. But they also have other sectors of growth that they're looking for. Just in terms of the natural gas harnessing that they've been doing with the methane gas underground, super interesting. A lot of recyclable things that they've been doing that's really cool. And overall, I just think that this business is going to continue to grow despite a lot of uncertainties. And you should be wanting to buy this stock not when there's a global catastrophe. You should want to already have this stock when things are going very well, and it's actually cheaper to get in comparison to when there's an emergency and everyone wants the stock. And vice versa, probably if there is like an emergency situation and the stock starts running up, you should probably sell. If you want to play this game, if you want to just hold it long term, I think that's probably the thing I'm going to do. I think it's a better strategy too with taxes, but you could very easily justify selling off a little bit of Waste Management if it does very well in a defensive situation, and then buying a stock that's free falling like a Microsoft, where you could have made a lot of money back. And I actually theorized that Microsoft and Amazon would be the two best performing Mag 7s. I said that Meta also had a chance, but I really didn't think it was very likely. Meta obviously is like the top performer, but nonetheless, I mean, the time to buy them was when they were dipping. I still think if you buy those stocks, you might even outperform Waste Management. Very likely could happen. But you're taking on a little bit more risk right now, and I don't really want a lot of risk. I'm very risk adverse. I want to buy things for where the risk-reward ratio makes sense. And now that a lot of these tech stocks are a little bit more expensive, I don't know if I really want to pay the premium, especially with Waste Management being under 230 with what I thought was a pretty good quarter. I really would just want specifically Waste Management. I also want to have more Vici. I don't want that to get away from me. I'm trying to just buy a lot more of that because I really like the yield that I'm getting from it, and I think that it's a very fair value, and I want to hold it for the long term. So I really like Vici as well. I'm trying to buy more shares of that. But really just going for more defensive plays now and trying to make my portfolio more heavily weighted with stocks like Waste Management instead of as much tech, just because I think that Waste Management is really going to be like a generational type of company, like the type of company you just want to buy and hold forever. And I don't think that there's a lot of companies that have still a lot of growth and are this reliable and defensive and safe. I really can't even imagine a more safe type of business model than trash. I really think it's almost like the perfect business, and I want to have a significant amount of money in it. And I think this is a good opportunity right now. I'm trying to put more into it gradually. I'm going to make a video, obviously, going through my full portfolio and talking about what I specifically added in the amounts. But I really wanted to make this video just kind of reflecting on the fact that, I think we're really in a time where defensive stocks, that's where you want to be. That's where you want to be adding right now. I think you could even take your pick. If you don't like my picks, if you don't like Vici or Waste Management, you go with Sherwin-Williams. You go with Procter & Gamble. I don't even think Johnson & Johnson's that bad. I haven't done a video on them in forever. Colgate-Palmolive, that's a good one. Pepsi, Coca-Cola, take your pick. I think some kind of defensive stock right now is probably going to be strong, preferably something where you still have the prospects of growth and, you're not going to be as affected by inflation because the cost of whatever machinery or items you're doing are very inflation-proof because once you buy them, you're just writing it off at that amount. Like the railroads, I think would be not a bad investment either. I made some railroad videos. I think that's a very monopolistic industry, just like Waste Management is. and there is a lot of capital that goes into the actual maintenance and the physical cars and gas and all those things. It's not very good margins, but they're still making money, and there's not really anyone that's going to compete with them. It's still a way to move products across the United States. So I think railroads could be good as well. I really think that the reason waste management is really the perfect business is that it's almost impossible to get landfills as well, which is a difficult thing. Just the fact that even if there is a really bad recession, people are not going to stop paying for garbage in the U.S. And I just think that it's going to be worth a lot more in the future as well. The organic growth's there. It's consistent every single year. The business is very strong. The business seems like it's thriving. And it really feels like tech and all these things are really back. And I think that there's going to be a lot more potential momentum upwards. I think that these stocks could be worth a lot more in the future. And I'm already pretty heavily invested in them. I don't really necessarily want to put too much more in. If there's an opportunity, obviously, that makes sense, I'll go for it. But I really want to just get more defensive stocks that are going to really pay a lot more consistently and slowly, not as much volatility, just consistently adding gains over time. I think that makes a lot of sense for my portfolio. I think that if you're playing a long-term investing, or if you're employing a long-term investing strategy, you probably want very safe, reliable stocks that are very boring, that you're getting at a very good price, that you can hold for a very long period of time and collect the dividends for over a very long period of time, because I don't really ever plan on selling my waste management. I really just want to hold it for a very long period, collect the dividends, and just feel really good about it. Maybe sell 4% a year or something like that. But I really want to build up the position first so that it can really grow and contribute to it until it just gets to a point where it doesn't make sense to buy it. Maybe it's too expensive. Maybe it makes more sense to buy tech again, because I think that it will make sense to buy a lot of tech again. I just feel like the prices are too high for my personal level of understanding, because I don't feel like my level of understanding is deep enough about the future of AI and the prospects of AI to make a really informed decision necessarily, unless I see something as quite cheap. And I think things are close to fair value, and I'm just going to sit with those positions that I have. I think that I'm going to go for the more defensive industrial stocks that I think are being really undervalued right now. And I think that the top of my list is waste management, but I also really do want Vici. I think that REITs are going to be really good, and I think that Vici is the best REIT in the S&P overall. I don't think that there's necessarily a better REIT out there, and with rate cuts coming, we're going to have refinancing, and I'm overall very bullish on these more boring companies that consistently make money rather than the next AI play. But I am still very bullish on Salesforce as well. I did buy one more share of that, but I bought a lot more waste management than I bought of Salesforce. And I'm going to continue buying more waste management as long as it stays below that 230 mark. I think that waste management is the right play. I've considered shaving some of my other positions that I'm up a lot more on and just funneling them into waste management, just because I think that, again, it's a very safe, secure kind of play. Thank you guys for watching the video. I really appreciate your support and all of the time that you guys put in to make the channel what it is. From the bottom of my heart, thank you. If you guys like this video, please check out some of my portfolio playlists or some of my stock analysis videos where I go through a valuation of stocks in the S&P or that are requested by viewers like you. Thank you.
Thank you for not smoking.
Hello guys, Dividend Enjoyer here, and today I kind of wanted to just talk about how I think AI is going to change the market and stocks overall for the better and not actually for the worse, like a lot of people have a lot of fears about. And I look at this from a historical perspective of how things have changed over time. really, like, to understand my perspective on this and my kind of opinion on this, you need to know that technology almost always raises GDP. It's one of the biggest factors in terms of, consistently increasing GDP from years. As technology increases, there's going to be more efficiencies, and then that means that there's going to be essentially more resources and services and everything just created as a result of that new technology. I think some of the most obvious examples in the 21st century would probably be the internet. Kind of interconnected everyone together and made it so that we could be a lot more efficient with a lot less resources. It was a lot easier to contact people. It was a lot easier to access information. It just ended up being a really big time-saving thing, and it led to a lot of different innovations in productivity. I mean, practically every job now that's, in a business setting or white collar usually has some kind of computer. I mean, really every job, if you look at it, is connected in some way to computers and to computing devices, which is a very interesting thought when we think about going forward and moving into AI. Now, I think that AI is going to make us more efficient as companies and as people in general. I think that AI is going to increase GDP as a whole just because it's a new technology that's being rolled out that, is going to make us just more efficient as a whole. And, I really think that long term, this is going to make it so that every company is boosted in what it can do and what it can produce. And that's kind of my opinion for the long term going forward. I think even your very traditional companies that are, kind of dinosaur companies that don't produce anything new, like maybe a Wrigley's or a Coca-Cola or something like that. With the adoption of AI into their enterprise, I think that you're going to see that they're going to be a lot more successful over time. I think that they're going to generate a lot more with a lot, much less wasted resources, if that makes sense. There's going to be a lot less waste just in general for these companies. And AI is also going to make it so that there's just more money in the ecosystem because there's going to be more products being produced in general for cheaper amounts. And it's going to make life just a lot better, I think, for the entire world and for everyone as a whole. That's really the way I more view it. I also don't think that a lot of these companies are going to necessarily be fully replaced, like Canva or Adobe. I think that they're still going to have, a place. I think that there's going to be consumer preference and still using them and still preserving the way that they do graphic design in that way. I think if people have learned through Canva or through Adobe, they're going to stick with that. They're not going to want to use AI. And I think there's going to be a really interesting kind of fight in terms of graphic design and art between the actual people and between the artificial intelligence on what's better. And I really think that AI is going to replace that role, which is unfortunate. But I think that it's hard to say, actually, because, I mean, who am I to know? I don't think anyone really knows which way this is going to go, if companies are going to elect to continue with people. It does seem like AI can produce a lot of very high-tech images that are very cool, but I still think that those people should be employed and be in positions where they can make decisions about the design. Maybe that's just the way we're going to move to more. It's going to be you're going to become a subject matter expert, and then you're going to dictate what the AI will do, which would be very interesting, kind of dystopian, but I don't know. That might be the natural progression that we're moving towards, and if it is, I think that we're going to have a lot more products created. The only thing I really worry about, like personally, and this is kind of outside of the stock market, but I worry that AI is actually going to make people not as smart as a whole. So that's just kind of something that I think is a little bit problematic and kind of scary. I think that it's going to make it more difficult to learn when you can just ask a machine the answer to any of your questions and it just instantly tells you, I think that there's going to be a lot more academic dishonesty, and that's going to have a really bad ripple effect, but we'll see. Overall, though, in the stock market, I think that AI is going to be really good. I think that it's hard to say, though, as well. But all I see online is that people think that it's going to be bad. I think that it's certainly going to increase our productivity for sure. I think that that's almost a guarantee. Not that I can use the G word and not that I'm a financial advisor, but I really think that AI is going to shape um, the future in a lot of ways. It's a new technology, but I also think that people were probably saying the same thing about the internet and that computers were going to take over. I don't necessarily think that computers are going to take over, right? Um, they're computers. I mean, even if they get sentience, I don't know if I don't know. I just don't see that happening because I feel like there's so many safeguards that we're so paranoid about. But I also think that we really kind of opened Pandora's box with this AI stuff. But I think that it's going to increase efficiencies. I think that's going to be good. But there are obviously some reservations that I have as well. Um, but I don't know. I think that people are being too negative about it. I think that's going to be like the internet, where it's going to be really sick, and then in 10 years, we're going to be saying, what were we even doing without AI? Um, man, we were living in the Stone Age. I think that's what we're going to say in like 10 years. But, if it's an awesome utopia where I have millions of dollars, cool. If it's Terminator, then I guess that sucks. But it's kind of my opinion on it. I think that AI is going to be good for the stock market. I think that stocks are going to look really cheap in the future just because I think that people don't even know in the long term what the cash flows are going to look like because the technology is going to be so advanced and so different. And I'm really excited for it as a holder of a lot of different companies. Thank you for watching the video. Please hit the subscribe button if you like rants like this. I really appreciate you guys. Bye. Hello everyone, Dividend Enjoyer here, and today I'm going to be talking about two stocks that I hold in my personal portfolio that just reported earnings today, and that's going to be Apple and Amazon. First off, I'm going to start with Apple because I feel like their earnings were a lot better and a lot more impressive just overall. Really happy with their earnings. Huge beats overall. EPS was 157, Street expected 143. Revenue 94.04 billion versus 89.53 billion expected, so pretty significant beat there. iPhone revenue is up, Mac revenue is up. The only things that really missed the expectations were the iPad revenue and then the other products revenue. But services revenue was up. I believe Apple TV did quite well as well. Overall, I think that Apple is just going to be a very, very valuable company that doesn't take many risks going forward. And I really like that for a long-term investment because I think that they're a very stable company and that they're going to very reliably make a lot of money. And we can see that here. Everyone has really counted this company out. We can see that in the after hours, at least when I took this screenshot, the stock's up 3.34%. So happy with my investment overall, but I really think that this stock probably should be higher valued because I think that there's a lot of intrinsic value to have the kind of ecosystem that they have. I think that that's very valuable, and I think that the advertisements are going to become more valuable. And if you believe that Meta is up because AI is going to cause more lucrative advertising, it would only make sense that Apple is going to get that kind of technology. You're not going to be able to replicate Apple's ecosystem of iPhones. You're going to have to come to them because that's where they have their value, and I think that's where they're going to make their money. So overall, good quarter, but for the long term, I think we're going to see a lot better quarters from Apple and not a lot of risk that they're really going to have to take as a business. Next up, we have Amazon, ticker symbol AMZN. I still love this company. They still beat on EPS with $1.68 versus $1.33, which is what the street estimated. The revenue was 167.7 billion versus 162.09, which was estimated. AWS came in just a tad above what the street was looking for, and advertising also came in just a smidge above. I think there were a lot of complaints with the AWS profit margins. Amazon said they were 32.9% in the second quarter compared with 39.5% in this year's first quarter and 35.5% a year ago. The second quarter margin results were at their lowest level since the final quarter of 2023. I think this is also just probably the fact that they're paying more for a lot of computing space and building it up. I mean, it's definitely not a good thing for sure. I really think that people are underestimating the fact that they have so many other things that could drive growth. And I also think that you'd have to imagine that they're pretty far up in the AI race. You'd have to imagine that AWS is also going to be very important going forward and just very valuable as a asset to have for any company. And I really think that AWS is going to have some quarters where it really shines and some quarters where it doesn't. And this is just one where it just didn't do well. And that was the main thing Wall Street was looking at. If the stock dips lower, I'm thinking that I'm going to want to own more of this just because I like when my companies make more money and are probably going to continue to make more money. And I just cannot imagine trying to make another business like Amazon. If you gave me $4 trillion, I wouldn't be able to do it. I think what they have is very important and growing. And I really think that it's going to become more valuable going forward as we get AI, as we are able to kind of reduce waste in their logistical systems. I think that it's going to become more efficient and they're going to be able to acquire more properties and gain more value. So I really like Amazon still. I don't think it was a very good quarter. Kind of disappointed with it, but I am very happy that, the actual earnings were very good. Really is hating, I think, too much on Amazon. I do think that the stock should probably be flat or up a little bit. It's kind of weird to me that it's down, but, I'll probably just be buying more of this stock. I think long term, people are really underestimating the value of AI in all of these companies. And I really think that Amazon's a special business, and I definitely just want to hold my investment. Most of my shares were bought at, I think, around $200. So I'll just continue to hold. I think that it's going to hit all-time highs again at some point, but maybe the expectations were just too high from Wall Street, but who cares? You just buy when those guys sell on good news. So happy with Amazon, happy with Apple. Not really happy again with those AWS profit margin numbers. And, it does kind of feel like Microsoft is kind of on a heater, and that's kind of pulling Amazon down here. It just felt like with Apple, like, we're finally bouncing up because, everyone is just so pessimistic about Apple. I think that it's going to break up maybe more. I think that it's going to really come up and be worth a lot more money as people kind of FOMO into it, because nobody's going to want to get in now. They're going to want to get in when it's at, 240, 250, 260. That's when everyone's going to want to be buying Apple and saying that you should have bought Apple so many months ago and everything like that. That's just the unprofessional prediction, but I see that happening. I have 15 shares now of Apple. Very happy to hold them. Amazon, I think I have 19 shares, and I think that both of these quarters were pretty good. I think for Apple, they were like very extremely good because the expectations were so low, like I said before. But from Amazon, I thought that the quarter was pretty good fundamentally. All the numbers look good. They're making more money. But some of those things where you want a certain amount of growth in certain segments that are going to be very valuable going forward, they just hit some of those markers on. And they also they estimated that they would make in their range probably lower than what Wall Street thought for, I think, operating income for the current quarter. So I'm not really a fan of, trading a stock based on an estimate that the company is going to make on their earnings. So I don't really care that much as long as the earnings are improving and going in the right direction. I'm happy to own Amazon. Even if they have a bad quarter, I'm still going to hold it. I'd probably buy more because I think it's such an amazing business. And in the long term, I really think that the company is going to continue to grow and be just a powerhouse overall. So thank you guys for watching. This is kind of my opinion of the earnings, my opinion of the companies, kind of how I'm feeling about it. Really excited for Apple. Kind of disappointed a little bit in the reaction to Amazon, but it is what it is. I understand why Wall Street's disappointed, but I'll probably be buying their shares once I get more paychecks. So have a good day, guys. Thank you for watching. Really appreciate you. Have a good one. Bye. Hello everyone, Dividend Enjoyer here, and today I'm going to be doing a stock analysis video of Costco, ticker symbol COST. Costco shares currently trade for $952.52. They're currently up 18.79% in the past year. The market cap of Costco is currently $422.42 billion. The price to earnings ratio is 54.03, which seems like kind of a premium to me. I would expect a lower price to earnings ratio, but I'm going to kind of talk about my opinion on why I think that price to earnings ratio is so high and potentially why I think Costco might be worth a premium. The annual dividend yield is currently 0.55%. So not really that crazy of an annual dividend yield, but they do increase it yearly. And that quarterly dividend amount, of course, 1.31. The 52-week low of Costco, $793.03. The 52-week high for Costco is $1,078.24. So we're definitely closer to the 52-week high than the 52-week low. I remember when I did my analysis of Costco, I believe it was around 920. So I think it was kind of before it ramped up, and now we're kind of back down. It does look like it does have some kind of momentum going upwards, but the reason why I really wanted to talk about Costco is because there are a lot of businesses that I really like the business model. I really like the company individually, but I think that the business is too expensive. And for a while, that was kind of my opinion on American Express. That was my opinion on Salesforce, and I might have been right because now Salesforce has dropped so much from where I had bought it. That had been my opinion with Microsoft when I had bought it, and it had dipped 10%. Then I exited for 10%, but I could have made even more if I would have held through the earnings. But what I'm trying to say is really, Costco is the type of business that I really want to own. It's the type of business that I think is intrinsically very powerful and valuable. When Americans think of Costco, most of them have some kind of opinion, and most of the time it's positive. I would think that Costco kind of ranks among the kind of brand awareness in terms just in the American psyche, just being such a big company, such a powerful company. I think that it rivals even that of Disney. I think it's really on that level in terms of just creating a wonderful experience and being a company that has just extremely positive values and culture. And I really think that Costco is really an exemplary kind of company and business that I would really like to own for the long term. What this whole rant is about is trying to say that Costco, I think, is a very unique type of business, and it's a type of business that I would really want to own. And I think we really need to have to just talk about the business model of Costco, and that being that you have to have the membership to actually be a Costco shopper. And what that does is it then funds a lot of the other things within Costco that are very advantageous. And I recently read an article by the Wall Street Journal that was very interesting about how because Costco created the Kirkland Signature brand, honestly, maybe the most just intelligent thing that Costco's done is the Kirkland Signature brand, and that could deserve its own video. But really, one thing that I saw that Costco was doing was they were actually shifting the production of a lot of their goods in the region where they're being sold. So they're kind of able to get around tariffs because they control a lot of the means of the actual production of the goods and the sales of the goods. They kind of have a monopoly on some of their Kirkland Signature products because obviously they are the manufacturer of those products. So it seems like Costco is very smart, very cutthroat when it comes to their suppliers. And it really seems like Costco has built a wonderful business that really gives a lot of extra equity to the consumer. And I wanted to kind of break down the financials because I personally would be willing to pay a premium for this business. It's done some very cool things in the past, like the special dividends that they do every couple of years. If you guys didn't know this, when Costco has enough free cash just sitting there that they don't know what to do with, they just pay the shareholders. So last time that was like a $15 dividend, I think. Just a special one-time payment to the shareholders. And I think that this business long-term is going to do very well. So I do think that I will eventually want to bite the bullet and buy this stock. I just don't know if it's time now or later for me, because I really do think that this would be a fabulous addition to my portfolio. It's either going to be this or Walmart stock. But I am definitely more positive and feel stronger positive connections with Costco than I do with Walmart's business model. Kind of with how I feel long term they're going to do. I think that Walmart is uniquely positioned in a very powerful company, but I just like Costco better as a business, and I feel like they're a more positive business, and I think that there's a lot more growth ahead for Costco because I think that they're going to be successful wherever they decide to grow or whatever they decide to do. Analysts are obviously very split on Costco. Currently, 16 rated a buy, 5 rated overweight, and 17 rated a hold, with 1 rating a sell. So analysts are really split between buy and hold. I think that it really depends on what your opinion is and what you are willing to pay in terms of a premium for that Costco branding and for the fact that there really only is one Costco. And that's kind of why it's alluring to me, but I don't think that necessarily means I'm desperate to pull the trigger on it. I want to get a good deal on all the stocks that I'm buying. I don't want to just get a fair deal. I want to be buying when there's some bargains. So I definitely think July would have been a good time. July 31st when it dipped into that 930, I think that might have been decent. I really want to get this stock though when it's at like 850 maybe, but we're going to plug into the DCF model and I'm going to show you kind of what I'm talking about. Average cost of capital, and you're going to see here that it's mostly equity weighted because Costco is 98% market cap compared to their tiny amount of debt of 1.92%, which is another reason why I think this stock is, really very nice looking, because it has very low debt compared to the actual equity weighting that it has, almost no debt. I think the only reason that they have this debt is for a potential tax shield. But I really don't think it's relevant at all or concerning at all, which is very nice to see, because some stocks can have way too much debt on their balance sheet, which is something that I think is a huge negative. Here we have my model for Costco, and we could see here that with a 13% average free cash flow growth rate over the next 9 years and a perpetual growth rate of 2.5% afterwards, the stock would be worth $822.28. Now, I think that there would be some more kind of intrinsic value to the Costco name and to the idea that they could continue to grow at a very high rate into the future. But I do also think that Costco is kind of a mature company. I know that they did raise their membership, so that's probably also going to help their earnings. I really think that getting at this at around 900 is like a very good deal. If we plug in what their average free cash flow growth rate has been, which it's been fluctuating a lot, I'm guessing that's because they've bought back shares or paid off debt or built more stores. But when we have that, we can see that it is a buy and there is 11.59% upside. But when we put in the average revenue growth rate, which I think is more in line, we can see that the stock would only be worth 600. So I think around 850 is where I I think it would be a decent deal, but I'd like to get in even lower. I'm not like rushing outside to buy that at 850, but again, there is a premium assigned to the stock, and that's where it gets really tricky because the free cash flow has been higher than the average revenue growth rate, and there have been weird times where they've paid crazy dividends. So this number maybe should be higher. The revenue has been growing pretty steadily, though, which is nice to see. I like 5.63% growth in the revenue on a company with no debt. In the long term, I think that you're still going to do well, even if you buy now at 952. I think that, and this is an unprofessional, non-financial advice opinion. I don't know what's going to happen with Costco in the future for sure. But my kind of best educated guess would tell me that Costco will probably do well in the future, and it's going to look cheap in a future multiple perspective. So the price to earnings ratio, if you bought now and then after a year's worth of earnings, is going to look very attractive. So that's just food for thought if you're someone who's a long-term investor, which I am. I think that eventually I'm going to bite the bullet on Costco. I'd just like to get more waste management while I think it's relatively cheap, and some more Apple while I think it's relatively cheap. But this is one that's been on my radar for years now. I've wanted to just hold it, but there's just other stocks that I feel like are more attractive, and I'm not necessarily in love with this sector. I don't necessarily think you're getting like a crazy good deal on Costco right now. So I think it's just better to stay disciplined here and not buy for me. But I definitely think that the stock is worth looking at right now, especially if you're going to hold it for the long term. They've had pretty consistent increases in revenue, which is always good. And I think that the company is, just exemplary in terms of the culture, in terms of what the company is founded on and the values and the idea that they want to create value for the customer. I think it's something that's ingrained into Costco as a whole. And it's a company that I really want to be able to own, but I mean, if we look at this growth rate of 8.31% of the free cash flow, compared to the average revenue growth rate, which is that 8.31%, we can see that, you'd be overpaying for the stock. I think 750 is like a steal. I would be looking at around 750 to 850, actually. I think that would be my range based off of this model. If I could get 850, I would be happy with that and to hold it for the long term. But I'm not necessarily jumping out of my seat to buy Costco here. I don't think it deserves that big of a premium compared to its potential future growth. But I do think that, if you're willing to hold it for at least 1 year, I think you'd probably make some decent money. I mean, you can see the past year it's been up 18.79%. So maybe it's time to own Costco, but I think that it's still too expensive compared to some other opportunities that are there. But I do think that they've built something that is amazing, and eventually I do want to own this stock and own it for the long term. So thank you guys for watching. My final verdict is I think it's a little bit expensive, but if you're wanting to hold it for the long term, I don't think you can go wrong with this business. I think that it's going to retain value pretty well, and I think that it's going to increase going into the future as well. And historically, they've treated their shareholders very well. So long-term good, but a little bit expensive. Thank you guys for watching. Really appreciate it. Please leave a comment. Hello guys, Dividend Enjoyer here, and today I'm going to be talking about debt and why I don't think that debt is a very smart thing to get into if you don't need to, or if you don't think that the value of whatever you're taking the debt out for is going to produce something that's worth more in the future. This doesn't mean like gambling options on margin or doing anything like that. I'm talking about if you're getting like a degree from your university, then that makes sense to go. If you're getting like a degree from your university, then that makes sense to go into debt for, because you're going to probably increase the future cash flows of your life over the long run. And it just kind of makes sense for a lot of careers you might want to go into. And then if you're buying a house, ideally you were trying to get something that is going to appreciate in value and be worth more money in the future. So sometimes that can make sense if you're buying a house with a certain percentage down and a certain loan. I still think that you are getting the short end of the stick on that, because you don't truly own it until it's paid off. And there's a lot of interest you have to pay off. I really think the bank has the edge on it a lot of the times when it comes to making loans, because if they weren't making money off of loans, they wouldn't be writing them. So I really don't think it's usually very smart to get a loan of any kind unless it is for education and it's, sensible. You don't want to get student loans for, like $400,000 if the most you can make in a year is $60,000. And that's kind of where your the limit of your degree is that $60,000 range. You don't want to take out $400,000 worth of debt. But if you're taking out like $20,000 of debt and you're going to go from, 60 to 70 to 80, and there's like a clear path up with this degree. Obviously, you might need a master's or something else to hit that next level, whatever that range is. But that's probably going to be higher than if you had no education, depending on what type of degree it is, the field, all those very specific things. But if you're making an investment like that on yourself, then I think that that's more low risk and makes a lot of sense for the long term, because it's something that's just going to improve your overall quality of life. But if you're going into debt for a house, that to me feels like you're making a huge risk on a transaction that's not very liquid. You still have to pay taxes for, even after you fully own it. Rates are very high right now. You have insurance. You have all these costs for this asset that is not making you anything, not generating anything, and you're in debt for it. So you're going to have to keep working past the actual value of what it's even worth. Whereas I can sit there and just pay rent and then put my money into stocks that are generating profits and that I could sell at any time with no real estate agent, no fees, nothing like that. Less risk because I'm not putting it into an asset in one particular neighborhood. I can have multiple different stocks that are in completely different industries, so there can be a difference in performance there. It's not like I'm making this massive, massive bet and, I know that my city's not going to be worth less money as a whole in 2 years, because that could happen. Or, the market falls apart, or, a million different things where I'm buying into something leveraged, only owning 20% of it, and the value of it could drop 30% overnight, Whereas with stocks, as long as I can afford to pay my rent, I'm good. I don't have to worry about all these taxes, all these different things, paying all these people for the transaction. I can just generate more equity, right? I think that makes a lot more sense to me than, having this huge debt on this one asset that's not producing anything versus having no debt and being able to put money into extremely valuable companies that are growing their profits every single year. I think I would rather have the pieces of companies that are producing things than the real estate that's not doing anything. That to me makes more sense, and it's more liquid. It depends obviously on the real estate too. If you find something that makes a lot of sense and is low maintenance and everything like that. But I still believe that instead of buying it on debt, you should just buy it cash, because I don't think that you can truly afford to buy it if you're using debt. I just think it's something you have to kind of, be willing to rent for a while and then make enough money to buy something with cash or put it into stocks, and then those will grow and eventually you can sell them and buy a house if you want one. I don't think it's that advantageous to actually be a homeowner. I think you're taking on a lot of risk. I think you're also taking on a lot of different costs. I think it only makes sense once you have a certain amount of wealth and you just want full autonomy. It's very easy to buy, but I don't think you should be taking out loans for a mortgage at all, honestly, unless it makes sense for your kids or something like that. I think it's totally different. Then I think it's okay to take out debt to help their future, because that's kind of a moral decision, and I think it's the right one still. But yeah, I'm not a fan of any debt. I don't think that debt is something that you want to get involved with at all. But I do think that individual good companies are where you want your money. You don't want it with a bunch of fees or anything like that. And you sure as heck do not want to be in any debt. If it's between paying off your debt or investing in a certain stock that I'm recommending, always pay off your debt, in my opinion. Because I think it's better to get rid of the guaranteed liability that you're going to have and introduce all this risk. Because what if your stock tanks and then you can't afford to pay off whatever debt, and then you get more debt put on? Then you're even more behind. But if you just pay it off, then you're done with it, and then you can actually start to build because you're not in the negatives anymore. So I guess for some people too, it's just a different state of mind. Like, I could not imagine trading options for anything other than something super strategic. And I think that taking risks really could put your money in other people's pockets really quickly that are selling you options contracts, which is something that I did used to do. Because I think that the casino tends to make more money than the player. I think the house usually wins. And that's how I feel about options traders most of the time. The people buying options usually are paying a pretty penny for that. They're paying the premium. Wherever I was going with this, though, I feel like debt is a very negative thing. You don't want to be in debt. You want to avoid it like the plague. If you're out of debt, be thankful you're out of debt, because it's not a very fun place to be. Thank you for watching. Hope you enjoyed the video. Please hit the subscribe button. Hello everyone, Dividend Enjoyer here, and today I'm going to be talking about my Salesforce position, which is down a significant amount since I bought in. I'm down about 11.35%. It's currently the worst stock overall in all my portfolios. And I'm just going to kind of talk about the philosophy on why I bought and what I'm going to be doing going forward with it. So I'm down, again, 11.35%, or about $264.64 on my Salesforce position. It's currently worth $2,066.15. But I paid $2,330.79. The reasons I thought that this stock was so compelling is, for one, the network effects, which I've talked about extensively. It's basically that it's very expensive to get out of Salesforce's infrastructure once you're in. And once more companies are in, they can continue to improve it. I also think Agentforce is going to be really big at replacing a lot of roles for companies in terms of customer service and those types of jobs, so that they can free up their income to put that towards other things. And I really think that Salesforce is going to be dominant in the CRM space. Salesforce currently does have a very high price to earnings ratio of 46.35, and the market cap is $282 billion. So there is room for it to fall, and I kind of knew going into it that I was paying a little bit of a premium upfront for Salesforce, but I thought that the stock would be trading at a similar price to earnings ratio going forward, and that it would continue to increase, and that I would regret it if I didn't add this company to my own portfolio, simply because the revenue is so consistently higher each year. And when you have a company that still has a lot of room to grow, and the revenue has consistently been raising each year, that's a really good company that you want to own for the long term. So I don't see this as necessarily even a bad thing. I'm actually going to do a full stock analysis video on Salesforce, mainly for myself and for you guys, to see what I think a fair value would be, and then determine if I should buy or not. So I'm probably going to be working on that over the weekend to give me kind of time to really think it over and understand if I want to commit more capital to this, or if something safer like an Energy Transfer or even American Express, because that's fallen as well, might be a better add to my portfolio. But the reason it dropped so much was because they expected revenues of $40.5 billion to $40.9 billion, compared with the analysts' expectations of $41.37 billion for next year. When they're forecasting lower than expected results, obviously the value that's been priced in, if it's lower from their expectations than what analysts are expecting, that's going to cause the stock to drop. And they're going to be starting to use this revenue range in their own models and in their own forecasts. And that's obviously going to hurt Salesforce, right? For me, being a long-term investor, this is going to affect the current price today. Again, in the long term, I think that they're going to be one of the biggest benefactors of artificial intelligence. And I think that Salesforce still has a lot of room to grow compared to a lot of the Mag 7 names. And I do think that this is more of a risky bet that I'm doing, but I still think that it's a very high quality company. I'm happy to invest more money into this if my DCF finds that it's at or below its fair value from my own valuation metrics. And I'm going to keep a level head. When I see the numbers go red, I usually am buying more to get my average costs down, because in the long term, I think that Salesforce is going to just continue to grow. And my thesis for that, again, is that it's very hard to get out of Salesforce's products once your company has bought into them. And more companies are going to want to join as they continue to improve the product. And it's such a specialized product, and it's the main thing that they're focusing on. And I just think that this company as a whole is very high quality, and I want this in my portfolio. I see Salesforce almost as it almost looks like a more risky, like a higher risk, higher reward version of American Express. And for that reason, I do kind of favor American Express more. And I do already have a lot of money into Salesforce. If the valuation is very enticing to me, I feel like I would have to go into the one that I feel like has more growth into the future and will benefit more in the future as analysts kind of realize that it was undervalued and as Wall Street kind of realizes that. But I also think that this stock is being hurt by the fact that tech companies overall are not being as favored by the market. I've seen a lot of defensive stocks rise where a lot of tech companies have fallen, and this will overall benefit my personal portfolio. But I still think that Salesforce is a great company. I think that it's an amazing company, actually, and I'm not going to sell any of my Salesforce. I when this type of thing happens, and you don't change your overall opinion on the company over the next 10 years based on maybe 1 year that's going to be bad, or even in my model, I'll be able to put this in and see based off of what they're forecasting, what the correct growth of the free cash flow is going to be. Maybe I'll come to a different valuation and maybe I won't want to add any more. But when this type of thing happens, you have to double down. And if you were buying it at a higher value and you think that the company's still worth around what you were valuing it at before, you need to buy more into it if you have the opportunity and if you believe in that thesis fully. If something happens with Salesforce that makes me change my thesis or opinion on the company as a whole in their future and what I kind of expect is reasonable, for one, I would either want to sell out or I would just want to hold my shares. But I don't think that for this company, because of the quality type of company it is and how specialized it is and how smart that they're doing these things and how I think the whole market is going to be able to benefit from artificial intelligence. But I think that Salesforce is really on the front lines of that and trying to be an innovator in this space. I think that overall it's a good bet and that I shouldn't be taking a loss on a company that's this strong overall. The consistently raising revenues and the network effects are things that I really like in companies. And I like to have a company that could grow exponentially compared to my other companies. I don't have the same types of expectations in the long term for a company like Waste Management as I do for Salesforce, but I would expect that it would be more likely that Waste Management is going to be able to consistently produce better revenues than a Salesforce and be in the positive, right? But I expect that Salesforce is going to grow at a way higher rate because the margin is better and overall just the company has better growth prospects because there isn't so much money going into physical assets. But I have better protection with companies like that, which is why I like them. Overall, when something like this dips as much as it has, same thing I did with Vici, I'm probably going to be buying more, but I don't want to say that until I've actually pulled out the model and fully modeled out everything with it and looked at every single company in my portfolio and kind of remodeled it out after this last earnings season. Because when I did my video on Energy Transfer, it looked incredibly undervalued for what you were getting. And I think that that company is a lot safer of a buy than Salesforce. But I also think that with Salesforce crashing down as much as it has, I think that there's a very high chance that it's oversold if you're looking at it from the lens of someone wanting to hold a company for 10-15 years, right? And a lot of people aren't looking to hold companies for 10 to 15 years, and that's why they get suboptimal results, because they're not willing to hold through a really bad time, and they're not willing to look at it from a growth perspective in what it could be in 10 to 15 years and what it could be producing in 10 to 15 years. They want to look at it from a 1 year perspective. And this is especially true of Wall Street because their compensation packages are usually based on them competing with the S&P for that year in that range. And I think that that's a very poor way to trade, but it's how the majority of asset managers do trade because they want to get their incentive packages for that year. And it would also be unrealistic for a company to give them 15-year goals because you don't know if someone's really going to be in that role for 15 years or I mean, there's a myriad of reasons for why that would be a bad idea to judge someone on their next 10 to 15 years. But as a personal investor investing in different companies, that's how I want to look at companies. And I think that Salesforce is still a very solid buy from that time horizon. Again, I'm going to revalue it. I'm going to really think about the company as a whole, think about if this affects my outlook in the long term, because I really don't think that one bad year is going to necessarily change everything in terms of what I'm expecting. So I'm going to find a price that I'm comfortable with owning more Salesforce. And I think that I'm going to continue to add Salesforce into my portfolio because I think that it's a very strong company. And it's a company that I think more people should be looking at. And especially at times like this when it's dipped so significantly, that's when you might want to be getting in, because even if it dips more, you could just continue to add more if your thesis and your valuation lines up. Like if your valuation is much higher than what the stock is trading at, and you think that it's just a psychological thing or a short-term thing that analysts are not seeing because their time horizon isn't as long, that's when you really want to be buying more into a company like Salesforce. And this is where the opportunities to make a lot of wealth come from, is when you're very strong in your convictions and very meticulous and calculated and not emotional. And that's kind of the lens that I'm coming from with Salesforce as a company. I don't want to be emotional about it. If my thesis holds true and my idea of what the value should be holds true, I should be buying more when it dips, and I should be fine when a company goes on sale like this, because I'm a lifelong buyer of stocks and I want companies to drop so that I can have opportunities to get in at a cheap price and hold them for a very long period of time. So I still think Salesforce is a high quality company. I'm very happy to hold it in my portfolio, and I really think that this could be a great opportunity to make a lot of money, and we're going to see in the future whether that idea holds true or not. So let me know what you guys think in the comments section down below. If you guys think that Salesforce is going to continue to make money in the long term, if you guys hold any Salesforce, what your opinion is on Salesforce products, and just overall what kind of videos you want to see. If you're interested in more in-depth stock analysis videos where I'm not talking as much just about my psychology behind my trading, I have a whole playlist on that. But I really enjoy talking about my own personal portfolio and why I'm not selling, or why I'm buying, why I'm holding, why I am selling, whatever the situation is. I like to have a video of that so then it can be a picture in time of what I did in my own personal portfolio so I can refer back to it. If you guys liked the video, please leave a like. If you guys made it this far, please hit the subscribe button. It helps me out a ton. Thank you for watching. Bye. Let's talk about the tariffs, guys. As you guys know, unless you've been living under a rock, there's been extensive tariffs against pretty much every country that trades with the United States, and this has obviously killed GDP. I'm not a real big fan of tariffs personally, and if you know anything about tariffs, they're really not good for anyone involved. And I'm going to kind of go through the reason on why rich countries are very rich and why poorer countries tend to be poorer, because there's a few different reasons kind of in modern day. But let's talk about Adam Smith and the Wealth of Nations. So in The Wealth of Nations, Adam Smith tries to summarize why he believes rich nations are rich and poor nations are poor, despite there being harder workers in poorer countries that don't reap the same benefits as even the poorest people in rich countries. And the reason for that is a specialization of labor. So what do I mean by that? I mean, take for example a sweatshirt, or even let's go with a coat. How long do you think it would take you to find all the pieces and materials and sew all the things together and get everything for that coat? If it was just you trying to make a coat, it could take up to a week to harvest the cotton or whatever's in it, to sew all the different parts, to find the buttons, to get the zipper and put the entire coat together. It would take a very long time, right? So your ability to produce one coat is very restrained if you're trying to get all the different parts for that thing that you're trying to produce. However, if you're just the person that attaches the zipper, or you're just sewing the coat or sewing the materials, and that's all you do every day, you're very specialized at it, and you're very good at it, you're probably going to be able to work on hundreds of coats. So you can kind of see that with every different thing that is produced, right? Whether that's cans of Coca-Cola, whether that's coats, whether that's boots, any good usually has multiple people working on a very specified thing. And rich countries have that specialization of labor that goes through different avenues. And moving that idea to modern day, we can see that there's a lot of different countries that have comparative advantages in different areas of manufacturing. You can see that kind of with the Chinese being able to produce a lot of goods, the Americans specializing very much in their software. I believe that's why America modern day is as rich as it is and has maintained being as rich as it is. But we also export a lot of different goods and services as well. But the reason that we are able to make so much money, and why globalism really does work for the United States, in my opinion, is that we're not having to make things that we don't have a comparative advantage in. So we're able to maximize our GDP in that way. And so when you have tariffs, what they really do is they restrict a country like the United States, or really any country, from being able to get the goods that another country can manufacture for cheaper and to be able to produce what we can manufacture with our comparative advantage. So now if you look at it, a country that might outsource steel from another country for cheaper, or whatever good you're looking at, let's say a car company for this example, if they outsource steel from China that's manufactured and produced there, they're able to get that cheaper price for that steel and produce more cars. But because they're no longer able to do that because the cost is too much due to tariffs, they're going to have to spend significant resources to produce that steel there, and they're losing out on potentially more cars, more jobs, and more GDP because they don't have a comparative advantage in producing that steel. All the while, countries that operate outside of a country with those same tariffs has a competitive advantage in the industry because they're able to get that cheaper resource and be able to produce more for less and sell more for less, because they're also able to operate in economies of scale, and they're able to produce more of that item than their competitors that operate in countries with tariffs as a result of the fact that their competitors are having to spend more money on something that they didn't used to have to spend so much money producing. And so you can see why this is not good. And this is very basic, right? I'm not an economist or anything of that sort. I have studied economics pretty significantly, I'd like to think. But tariffs are not good for anyone. Another thing that really hurts countries, but isn't really as much in the subject of tariffs, is corruption. I think the best example of this is the Russian economy, which is kind of an oligopoly. And this kind of bureaucracy and corruption is really bad because whenever someone innovates in a great way, that company or that innovation is given to one of the billionaires or the president himself, and they reap the rewards of it. So that's obviously a flawed incentive structure when you have a lot of corrupt people controlling the government that will seize your company or seize your assets immediately. So, again, that's kind of off topic, but those are kind of the two ways that industry can really be hurt. And as a result of that, the Russian example, that's why Russia really only exports weapons and natural resources, because nobody wants to create anything there. Just like how in the United States, now it's going to be a lot harder for our companies who produce things to be able to produce as many things because now they're going to have to be spending more money due to a tariff. And tariffs are disastrous just in general, along with corruption for a country's economic output. They're not good. I think that they're being used in a negotiation tactic here, which is why I'm buying more uh, shares of companies that I really like, anyways, and that I've valued quite highly. And I kind of have this philosophy because I had this philosophy when the Silicon Valley Bank fell. I bought a lot of banks during that time because all the other banks crashed and there was a temporary bank run. A lot of people probably don't remember it. But my kind of philosophy with this is either the tariffs are going to get dropped and we're going to be okay in the long term, which I do think we're going to be okay in the long term either way. This is just going to be a bump in the road. But if it gets a lot worse and the tariffs continue and prices continue to rise, then it's going to be bad no matter what, right? But if it gets better, then this is a unique opportunity to be able to buy the things I really want to buy. So I doubled down and I put another $1,500 in today just because I think that these deals are great and there's a lot of companies that I love and I'm going to continue to love into the future. And I know that they are being adversely affected by these tariffs and there are ripple effects that are going to hurt them for sure in the short to medium term time frame, and that if these tariffs continue, it's probably going to seep into the long-term results for their free cash flow and revenues and things of that nature. But a lot of these things are very temporary, and the United States has persevered through many, many different challenges, through world wars, through disease, through depressions, and they've come out ahead. And I really believe that, kind of because of the corruption thing I was talking about earlier, that the United States is an amazing country because of the fact that it allows for non-bureaucratic ways for people to innovate. And the government isn't paranoid about companies taking over and having influence because they already do. So when you have that system and you're not afraid to let companies become powerful, to let them make money, they can do really incredible things and make fortunes for people. And for that reason, I think that the United States is going to persevere. There are a lot of people who have bet against the amazing ability of the United States to produce and to innovate and to be able to do things that have never been possible in any other nation. And while I think these tariffs are embarrassing, just bad economic policy, and overall going to bring a lot of pain and not going to be good for a lot of people, I think that it'll be okay. I think that we'll get through it. And I think that long term, a lot of the companies that I like because they're very quality companies are probably going to be looked back upon as very cheap right now. I do think that we could continue to drop, and I think it's impossible to say what will happen because there's so much uncertainty in this administration, and I don't think things are being really well planned out. I think that there isn't really a general understanding of how to do these things or what the right approach is, but I think that we'll get through it. And I think that it's going to be okay, especially if you're someone who buys into a business and plans to stick around for a long while. I think that you're going to do all right. I think I'm going to do all right. But I do think that there's going to be times of great difficulty in an investor's lifetime and just in holding any investment. There's going to be times of difficulty where you question your own judgment in a lot of ways and you see that everyone else is selling out. But history has proven time and time again that those are the best times to buy in and get more shares for less money and hold through and wait it out. Really, that's all you can do. You can just wait it out, and if your convictions are proven true, you'll make a lot of good gains. And if not, you can continue to keep buying in if you believe that the companies are going to be very strong and produce more revenue. But if it is a really catastrophic event that's going to alter our companies and alter the investment landscape, I think that it's going to be bad no matter what, whether you have money in or not. So I'm looking at it as kind of, it's going to suck either way. And I really do believe long term we're going to be okay. But if we're not, I mean, it's the same thing I talked about with the banks. If we're not okay with this tariff stuff and the country nosedives as a whole and everything falls apart, I mean, it doesn't really matter if I invested the money in stocks or not, right? It's the same thing, like I said, with the banks. If I buy JP Morgan and JP Morgan goes under tomorrow, well, there's a lot of other problems than my investment in JP Morgan. Let's just say that. It's the same thing with the tariffs. If the United States economy falls completely apart, I think that I'd be more concerned about a lot of other things than my stock investments. Let's just say that. But yeah, those are kind of just my ramblings and my kind of initial thoughts about it. I think that we will be okay. I think that tariffs are very poor economic policy. I hope that they get repealed in some way, or there's a sit down with all the different countries of the world with this administration, and they have a more calculated approach to this kind of thing, because it seems like a lot of the judgments from this term have not been well thought out and quite frankly have just not been implemented in an intelligent way. It feels a lot more emotional, and it feels like a negotiation tactic rather than a permanent policy. And we've seen this administration about face about things at different times and change their mind and change their view on something that they had recently had very strong convictions about. And I think that this is one of those situations, because there could be dire consequences if the tariffs continue, and I trust in this country above everything else. This is really an amazing country to be an investor in, and it's just unfortunate, but it's a good opportunity, I think, to be able to buy into the companies you like, and these are the things you look forward to if you want to hold for the long term and you believe that they're only going to be temporary, which I do. Let me know if you guys like this kind of video. I kind of just rambled with my scrambled thoughts about the whole situation and tried to explain what I was thinking about in the best way I could. But yeah, I'm really interested to hear what you guys have to say. Thank you so much for watching. Goodbye.